Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields a tad lower today after what we've seen recently, the run up, all the way to 295 in yield. We've seen a modest pullback. We end the day today around 286. That number might ring a bell because it's where we've settled the last 3 Fridays. And right now the 286 level becomes, well, do we spring back towards 3%, which is really the bullseye here. That's the level that the 10-year note's been trading towards and has been talked about for months. We haven't gotten there yet. We've gotten just below it, but we've not been able to see that push through. And to the downside, we're looking at 280, but that's not a level that we're seeing frequently either. So right now, 285 to 295 seems to be the range, at least until we get a catalyst. Some thought that the Fed chair's testimony to the House would be it. Maybe tomorrow when we get him to testify to the Senate Banking Committee, that could be it. The Q&As will be different. The speeches will be the same. But I think ultimately the message he is sending is that this is not your typical Fed that you've seen over the last 4 years. It will be his Fed with, yes, gradual rate increases. And yes, there will be a possibility of maybe a surprise here or there. But ultimately, I think he wants to put his name on this Fed, and that's kind of what's got the market scratching its head and why we're not seeing any breakout trades. Equities have traded lower here. We've seen the dollar rally, so there has been a little bit of correlation, but the bond market has been relatively steady, still waiting for some kind of a confirmation or a catalyst or something to see a big move. And if you look at market volatility, it remains elevated. I know we've been saying that recently, but we haven't said that for a long time, and it's been sustained at higher levels, something that we haven't seen for a very long time. So market volatility in the Treasury side is still very much rich. Not necessarily saying that means we're going to see yields spike to 3.25%, 3.5% overnight, but it certainly means that the market is still questioning whether we're going to see a move to 3% and above it, or if we're going to see a trade back to 2.5% or below it. Those are kind of the extremes, and that's something that we're still scratching our heads with. We do have Fed chair speaking tomorrow. We do have key inflation data on Friday, and we do have an FOMC meeting next month. Those will be the catalysts, the reasons why I think we could get to 3%, but then it all becomes what happens when we get there. Do we continue through it, or do we pull back, or does someone in the Fed say something? And today someone in the Fed did say something. Neil Kashkari out of Minneapolis, he was talking about, he's been a recent dissenter of Fed rate hikes, talking about the need for not only inflation to get to a sustained 2%, the Fed's target level, but also for wage inflation, something that really hasn't been seen. We've seen the average hourly earnings numbers get moved up, but some are saying that's just a modest change when you take out the weekly average hours worked. And so there is a wage inflation component as well as an inflationary component, something that we need to see combined. And I think that may be what the bond market's waiting for. Do we really have inflation from the wage side? Do we really have rising inflation on the CPI side and the PCE side? So right now we'll get the PCE data on Friday. We don't get it tomorrow. We get it on Friday. Tomorrow we do get Mr. Powell to speak to the Senate Banking Committee. Both those events could get us to 3%. I don't know if we'll get there. Certainly Powell said what he wanted to say, but the Q&A may throw a curveball. Likewise, if inflation comes in through the roof on Friday, that would be a reason to get us to 3%. But ultimately, I think the market's waiting to see what happens at March FOMC, forward guidance, projections, and the press conference. That'll be the event, I think, that gets us to, if we haven't been to 3% yet, and above. Likewise, it could be the reversal because March has been a meeting that has had some ripple effects on the rest of the year. If you go back to 2017 and 2016, both in opposite directions, but similarly, the bond market rallied, despite the fact that the Fed wanted to remain hawkish, or as hawkish as they could be given the period. So right now, 10 years still spinning their tires, waiting for that next event. Could it be tomorrow with Powell or Friday's inflation? We'll have to wait and see. This is Todd Colvin coming to you from the floor of the CME Group.